Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage-eitel.
All right, guys, my name is Mark-eitel, and this is the Mr. Mortgage Show. And friends, you are in the right place if you are confused, if you're frustrated, if you're just fed up and you want to know what are the straight facts, what's going on with the housing market. Is the market going to crash? What's going on? Guys, each week we do this show to give you the tips, the tricks, the strategies, the answers to all your questions, and the information that you need to make better real estate and mortgage decisions for you and your family. Guys, if you have questions or comments along the way, we encourage you to call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is womanning the hotline. She will get your questions on the air. If you prefer to shoot us an email, just go to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over to Jen that way, and she'll read them on the air for you. Last week, wow, what a great group of questions we've had. I swear we've got the best listeners in all of real estate and mortgage talk radio. And let's keep that rolling this week. Hey, I often get accused of being a little too optimistic when it comes to the real estate market. I have a tendency not to share in the general frustrations, right? And guys, I am not looking at the world through rose-colored glasses. Let's start there, right? I'm totally aware of how quickly we've appreciated, and I have the same fears that a lot of people have, that an entire generation is going to get left behind. If you've listened to the show for any length of time, you know that I was pretty much born into this business. So I come from a family of home builders, custom home builders, and real estate's been in my blood since an early age, if you will. So I know the value in building equity and passing that equity on to your children, but also benefiting from that equity along the way just through the normal ups and downs in life. You know, if you never buy that first house, you don't have the equity to do a cash out refinance to buy some investment property, or to renovate your property with the proceeds, or to cover some unexpected bills. I mean, we recently did a transaction for a couple, and they had run up a lot of credit card debt doing not experimental. I guess that's not the right word. She was suffering from cancer, and they got signed up with a lot of trials, and they traveled a lot. They went to the Moffitt Center down in Tampa. There was a cancer facility out in Arizona, and that travel cost them tens of thousands of dollars. Well, good news. She's cancer-free. She beat the odds because the doctors had indicated that this was going to be terminal. But at the moment, cancer-free. But she had to, husband and wife, they did a cash-out refinance debt consolidation loan to pay off all of the credit card debt. And they would do it over and over again if they ever had to. But my point is that equity did that for them. That equity allowed them to chase that treatment and then be able to pay it off. They didn't have to file bankruptcy. So I get the importance of it. I truly do. And I'm as concerned as everybody else that, you know, we're pricing a big percentage of our young people out of the market. But guys, I'm finding opportunity in every market, and I want to share it with you. And this one goes out to the parents and the grandparents. I was recently talking to a good friend of mine who has young children. They range in age from about 8 to about 14 or 15. I'm embarrassed that I don't know their exact ages, but I'm holding my hands up in the air as I'm describing their age, because that's not being a parent. That's how I equate children's age. They're about this tall. But anyway, he was sharing with me that he's super concerned that his son, who's 10, he did share that with me, is never going to be able to purchase his first home. Because by the time he's ready to buy, my buddy is super concerned with where prices are going to be. And based on the career path that he anticipates that's lining up for his child, you know, he's not inventing new software or patents for cancer curing drugs. This is going to be, you know, a very smart child that has probably an average or slightly above average income. So buying a property in 15 years is going to be really, really challenging. So we were talking and we came up with what I believe is a brilliant strategy. He, like everybody else, has a ton of newfound equity. Now, his kid's 10. He doesn't need a house yet. But what if, and this is what we're working on, what if he pulls some equity out of his current property and uses that money to buy a rental property, a nice home in a nice neighborhood that he can rent out to cover the bills, let the tenant pay the bills for 15 years, and he's got a property that essentially cost him nothing out of pocket because he extracted the equity from his current property. The tenant is servicing the debt on the new property. He didn't lose any equity because he traded the equity in the house for the equity in the rental, created cash flow from the rental that he's using to pay the additional debt on the house because he's having to pull the equity out of the house. But my point in all that is a creative thought process is, wait a minute, I can buy my kid's first house right now for him. Let someone else create a great equity position that will allow him to, with a gift of equity, sell that property to his son in 15 years or 12 years or whenever the kid's ready. But that's an opportunity in this market. Why? Why is it an opportunity in this market? Because he's never had this much equity in his home. He's using the past rapid appreciation cycle to create opportunity to go buy another property. And let's say properties never go up in value again. That tenant is paying that principal down, so they're creating equity by principal reduction. So he's going to have equity in two properties, and it's like layaway, guys, but that someone else is paying for. He's putting his son's first house on layaway, so it's there when the son is ready. And if the son is never ready, he's got a rental property creating positive cash flow that he can sell at a profit in the future. So guys, when you hear me say, look past the headlines to find the opportunity in the market, these are the conversations that I'm having with my friends and the professionals that we network with. We're creating strategies to help people find the golden nugget, if you will, at the end of this big poop storm that we're seeing in the news every day, because there is opportunity out there. There was an interesting article released that said the U.S. needs about 4 million houses to be delivered to the market right now, today or tomorrow, to meet the current demand. And we know that's not happening. So supply and demand still dictates that prices are going to hold. So why not be creative and buy your kid or your grandkid's house now, put it on layaway, let someone else pay for it, and then it's ready when they are. And guys, I'm not suggesting that that's the right plan for everybody, but what I'm suggesting is that when you look for opportunity, you find opportunity. When you look for obstacles, guess what, guys? You only find the obstacles. And it's like skiing through the trees in the snow. If you focus on the trees, you're going to hit the tree. But if you focus on the path, there's a way through it. So hang with us, guys. We're going to get you through those trees. But first, we got to get through this commercial break. You hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is the always optimistic Mark Eitel, host of the Mr. Mortgage Show. And guys, you're in the right place because we are about to dig in. I am alluding to that opening segment because I already saw a couple emails with some questions regarding what I was talking about. And I'll cover those here in a second. But guys, questions or comments, shoot them over to us, 855-462-7292. You can text or call that number. That's the Anytime Hotline, 855-462-7292. One more time for the kids in the back, 855-462-7292 is the Anytime Hotline. Hey, and I encourage you to write that number down because if you need us when we're not on the air, that pushes to my office. It rings right here in the studio when we're doing the show, but the rest of the time it forwards to my office. So you can always get us, and we're always happy to answer your questions. But if you prefer to shoot us an email because you don't want to talk, I understand. In this technology age, we're all texting and emailing. Go to MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page. Click that little email icon that looks like an envelope, and you can shoot your questions over to Jen via email, and she'll read them on the air. The two questions that came through during the break were, I referenced not costing them any money, and what I meant by that was they're trading equity in the house for the rental property, so they have the same amount of equity, but it's now spread between two properties. And yes, I was referring to using the landlord loan to buy the rental property because then your income is irrelevant, assuming that you have the credit and you have the assets. And yes, the assets can be home equity line of credit. Yes, the assets can be equity extraction in the form of a refinance to buy that investment property. So I hope that clarifies it. But yeah, we've had a great response to that, and it's working. It's working. And if anybody has any questions about how to make that work for them, give us a call or shoot us a text or an email. I'll be happy to walk you through it. If there's any way that we can help or the Really Great Agents Network can help, I'd love to be a part of it. But guys, if you missed that first segment, go to MrMortgageRadio.com and click on the show link at the top, because each week after the show airs in all of the markets, Jen posts the recorded version as a podcast up to Mr. Mortgage Radio. So yeah, check out Mr. Mortgage Radio. There's a lot of good stuff there. But anyway, speaking of Jen and speaking of your questions, let's get that part of the show started because it is my favorite part of the show. So, hey, Jen, throw me question number one.
Terry sent us this. Is there a prepayment penalty with the rec refinance? I'm wondering if we do the rec refi now to take the pressure off, and in a few years, after the elections, rates come down, will we be able to refinance then? I think things are going to get weird around election time, and I'd like a little money socked away.
Oh boy, Terry, are they ever going to get weird? Politics aside, right? Because we are so divisive that I think we're all bracing for the last election on steroids because people have their heels dug in deeper than ever before. But man, with the advent of AI and what people are doing with the AI technology, it's going to be hard to determine what you're actually hearing and who it's actually from. I've seen some being in the radio space, AI created voices and videos and all of that around media. I'm seeing it behind the scenes, and it's fascinating. And it's not there yet, but it's getting there pretty quickly. So anyway, Terry, I agree things are going to get weird when it comes to election time. But yeah, hopefully we can all remember that at the end of this, we're all on the same team. So hopefully we'll row in the same direction. But hey, to answer your question, the rec refinance does not have a prepayment penalty. So the way that you just kind of storyline that out, do the debt consolidation loan now, right? Pay down all your debts, reduce your total monthly payments, and then kind of sock away some of that money for any craziness, if you will. That's not a bad strategy. And we're seeing more and more people do that. A little less about the anticipated craziness of the politics, but a lot more around concerns for a serious recession, and people are doing debt consolidation and cash out refinances now while they still have equity, because some people do believe the market's going to crash. So if you want to pull equity out to get yourself through troubled times, you can't wait until the market crashes, because then you don't have equity. And you can't wait until you lose your job because you don't have the credit or the income to qualify for the loan. So we're seeing more and more people step up to the plate. And even though rates are higher, a lot of people are saving money each month by paying down the car payments and the credit card payments and all of that. And I shared a story last week, or it might have been the week before, where a gentleman did a rec refinance to pay off some trucks that he had purchased during the pandemic. And it wasn't because the trucks had bad interest rates. It was just that he was so upside down because at the moment that he bought the trucks, they were so overvalued that he's upside down now, and he can't sell them, not for the payoff, and he can't trade them for the payoff. So he's kind of stuck with them. So he just did a debt consolidation rec refi. He's got them free and clear now, so he can make a move if he wanted to. But more importantly, his total monthly outflow, meaning everything that leaves his checkbook, is less now than it was before he did the refi, regardless of what it did to the interest rate or the mortgage balance. So, Terry, brilliant question. Yes, you can refi again in a year or two. I don't advise it unless rates are significantly lower, because you don't want to pay a second set of closing costs. And while we're talking about that, guys, there are a lot of people out there that are advocating for buying a property now, and they're almost promising you the opportunity to refinance it. Guys, you don't know what's going to happen in a year or two. And if you have one of those temporary buy downs and that rate jumps back up, you've defeated your purpose. So I'm a much bigger fan of buying it down with a permanent buy down, so you win either way. But Terry, to answer your question, you can absolutely refi again in a year or two if that's what you choose to do. But if you set everything up correctly now, and you could even buy your rate down a bit, right? If you're willing to pay a second set of closing costs in 2 years, take that money that would have been the closing costs in the future and use it to buy your rate down. You may never need to refinance again. But brilliant question. And I agree with you, brother. Crazy times are coming. But speaking of what's coming, you hear the music. What's coming around the corner is a very short break. Sit tight. On the other side of this break, we're going to dive into more of your questions and be back with more of the Mr. Mortgage Show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And you, my friends, are in the right place if you want the data, the tips, the tricks, the strategies, the answers to all your questions so you can make better real estate and mortgage decisions for you and your family. Hey, and speaking of your questions, keep them coming. Terry just threw a great question at us before the break, and I'm hoping for more. So if you have questions or comments, call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline, and Jen will get your questions on the air. Or send us an email, and you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and shoot your questions over to her that way. But hey, let's keep them coming. I know Jen's got a few back there. Are you ready? Okay, Jen, what do you have?
Anna is asking, how soon can we refinance? We bought 6 months ago, and it feels like we got a bad rate. Also, we have a bunch of equity and would like to pay off both of our cars.
Hey, that's a great question. I don't know that the rate's going to be much better today than it was 6 months ago, unless you really got a bad rate. But you may have. And if you want somebody to take a look at that, I'm happy to. Just call us off the air. I'll take a look at it. Guys, we do that fee sheet review too. If you've gotten a mortgage quote recently and you're not quite sure if you're getting a good deal, check out feesheetreview.com. It'll walk you through how to get a second opinion on that. But hey, to answer your question, 6 months, you could refinance again in 6 months. Most loan programs don't have a timeline on how quickly you can refi. Most mortgage companies don't want you to refi for at least 6 months because they don't want to be hit with what's called an early payoff, meaning a portion of the fees have to be rebated back to the lender, not out of your pocket, out of your original mortgage company's pocket. So oftentimes people will tell you 6 months for that reason. But if you want to use the appraised value versus what you paid for it, then there are some timelines that come into play. If you think that you got a great deal back then and suddenly it's worth quite a bit more, then depending on the loan program, you might have to wait as long as a year, but you may be able to get away with 6 months also. But call me off the air and let's talk that through, because I would need to know a tiny bit more information to give you the very best answer. But on the surface, 6 months, if it was 6 months ago, you can certainly execute a refinance now. Just make sure that you're saving enough, because as I mentioned, the rates of today aren't that different than they were 6 months ago. But brilliant question. Hey, Jen, toss me another one.
Drew sent us an email. We've started looking at rental properties. The realtors keep asking for a pre-approval. But how can I get a pre-approval until we know the cash flow of the property? Am I correct in thinking you'll need that info too? We've talked with Taylor at your office, and she's given us a pre-qualification for now.
Hey, that's a great question. And I'm glad you're working with Taylor, because she is a rock star when it comes to the landlord loan. But you're absolutely correct. So you can be qualified as a buyer. With the landlord loan, we're not looking at your income. So if you've been through the process with Taylor, you have that raw package in your email, that RAW, ready, able, and willing. And I would encourage you to have your agent watch that video that's part of that package, because that will clearly illustrate that you, as the buyer, are fully qualified. We have verified your assets and we have verified your credit. The only thing at that point that is a wild card is the property, because you're absolutely correct. The property has to cash flow. It has to pay the debt with the landlord loan. Even if it only breaks even, it'll qualify for the landlord loan, but you have met all of your qualification requirements. And that raw package is a clear indicator of that. And I find that even though we do our very best to make it super simple for the agents to understand, a lot of agents don't open that video package to see what's in there. But you're right. You're qualified, but you can't get the approval until we review the property, guys. And that's just how it works with income producing property, because the income that we're using to underwrite the transaction is indeed the income from the rental property. And it could be that your agent's just not familiar with investment properties, because if you're buying your primary residence, we give you the full underwriting approval. Your income's been verified, your credit's been, your employment, your assets. All we need to do is plug a property into the equation. And that may be where your agent's mind is. And he or she may not be familiar with income producing property to the point that they're aware that the income component is underwritten based on the property itself. And it's going to be different for every property. So brilliant question. If you want me to jump on the phone with your agent, personally, I would be happy to do it and walk them through the process and just confirm what I'm sure Taylor's already said and let them know where you are, because you've gone as far as you can go until you identify a property, and then we can look at the cash flow. So brilliant question. Hey, Jen, throw me another one.
Maya sent this. How do we figure out the best amount to rent our house for? We don't want to work with an agent. We just want to know how to figure out a good price. Hey,
Maya, that's an interesting question. Here's one thing you could do. You could go to Zumper, ZUMPER.com, and see what the average rents for your property type in your zip code are. That would be a good jumping off point. Some of the bigger websites have estimates for rent. Here's one that just jumped to my mind. We do that property value report as a service for our listeners, and most people use it because they're trying to determine what their property would appraise for when it comes to either selling it, refinancing it, or insuring it. But one cool piece of that report is also the projected rents for that property in that neighborhood, and it'll give you an estimated rent range. And I'm happy to run that for you. You can go to mrmortgageradio.com and click on that free value report link and just put the property address in there, and we'll email it over to you. You don't even have to put your phone number in there. Nobody's going to call you unless, of course, you want to talk. But that might be the easiest way. Check out Zumper, ZUMPER, and then go to mrmortgageradio.com and request your value report. And if nothing else, it'll kill two birds with one stone, because you'll know a pretty good idea of what the property's worth as well as what you could rent it for. So that's at freevaluereport.com or mrmortgageradio.com and click on that free value report link. I hope that helps, and I'm throwing that offer out there for any of our listeners. A lot of people are going through turmoil right now with their insurance premiums getting requoted, and oftentimes people are unaware that your lender requires that the property be insured for the replacement cost or the loan amount, whichever is less. But knowing what your property value is often helpful when determining insurance. So you can use it for that too. But anybody who wants one, hit that link, and we'll be happy to run it for you. But give us a little bit of grace. It may take a day or two to get it back to you, because we do run those individually. It's not solely an automated service. But anyway, Maya, thank you for that question. I hope that helps. Guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this short break. We'll be back with more of the Mr. Mortgage Show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to mrmortgageradio.com. That's mrmortgageradio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
We're back. Hey guys, it's Mark Eitel, and you are tuned into the Mr. Mortgage Show. Hey, if you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292, affectionately known as the Anytime Hotline. Because when we're not in the studio, that forwards to my office. So it rings right here, and Jen will pick it up when we're in the studio, but it also pushes to my office, 855-462-7292. Or head on over to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over to Jen that way. And guys, great questions so far. Man, oh man, another action-packed week here at the Mr. Mortgage Show. Let's keep them rolling. Jen, toss me another question.
Barbara sent us an email. How long after we close on a rental property before we can buy another using a landlord DSCR loan?
Hey, Barbara, that is a great question. And for people who are wondering, what is a DSCR loan? The landlord loan is essentially a debt service coverage ratio, DSCR loan. And that basically means if the rental income covers the debt on the property, so debt service is covered by the income from the property at an adequate ratio, then you don't have to disclose any personal income. The income from the property is all we're concerned with. So to answer your question, Barbara, there's not a time limit. However quickly you can drive from one closing to another, you can close the second loan, because we're not looking at your income, we're looking at the property's income. Assuming that you have adequate assets and credit to meet the requirements, you could close multiple landlord loans on the same day. So brilliant question. I hope that helps. And if you need more information, feel free to give us a call or shoot us an email. I'll jump on the phone and help any way I can. Thanks for that, Barbara. Hey, Jen, throw me another question.
Eric sent us this. My wife is not currently on my mortgage. If I take out a reverse mortgage, should I add her to the loan? What happens to her if I die first and she's not on the loan? Her credit is not great. That's why I'm asking.
Hey, that is another fantastic question. And there's two ways to do this. She doesn't have to be on the loan, meaning underwritten as a borrower. The loan can be structured so that if you pass away first, she can stay in the property until her death, and she can be under 62 at the time of closing, and this still work. Now, if we can use her on the loan, it's an easier process, and you say her credit's not great, so that's your concern, which it's a valid concern if her credit is really bad, but the reverse mortgage product is not credit score driven. You hear the term all the time. I've said it many, many times. The underwriting term that is tossed around is the ability and the willingness to service the debt. So if you can demonstrate that, regardless of the credit score, then you may be fine. But you can look at it both ways. You can look at it with her involved, and then if for some reason it's not working, because depending on how bad one spouse's credit is, it might require the LISA, L-E-S-A account, which is going to tie some of that equity up in an escrow account for future payment of taxes and future payment of insurance, because that required ability and willingness wasn't met because of whatever's showing up on the credit report. And then to avoid the LISA account, you may be able to just do it without her being underwritten as a borrower on the loan, but she'll still be protected under the other guidelines. So I'm happy to walk you through it. It sounds complicated, but I assure you it's not. We've done it many, many times. And where oftentimes it comes into play is where one spouse is under the 62-year-old age group. And with that instance, they're still able to live in the property until their death and be protected from oustage, if you will. They're not getting tossed if you go first. But man, great question, and kudos to you for thinking of her. So that's awesome. Hey, Jen, okay, go ahead.
Amanda sent a text. We were planning on using an FHA loan to buy a condo later this summer. But I just heard not all condos are accepted by the FHA. Is this true? Is there a way to know if a building is okay for FHA or not?
Hey, Amanda, that is a great question. And yes, it is true. So for a building to be FHA approved, there are certain stipulations, like a certain percentage of the units can't be rentals. They want, primarily owner-occupied properties because the FHA is designed for owner-occupied. So There is a bit of scrutiny placed on the association and when the documents are reviewed, but there's an easy place to go to see if the condo is already approved or if it was approved in the past. If it was approved in the past and not currently approved, it could have been that somebody just didn't go through the renewal process. And in those instances, what we call a spot approval is an option. So, but yes, there's an easy way to do it. I don't know the link off the top of my head. It's got a .gov behind it, and there's a full searchable list by city and zip code nationwide of projects that are already FHA approved. But if you go to mrmortgageradio.com and click on the Facebook link, I'll post it to the Mr. Mortgage Facebook group, and everybody can use it. It's a link to the FHA.gov/something/this, that, and the other. And then you can search yourself actually, you could search the zip code, pull up all of the approved buildings, and then give that to your agent and say, I only want to see condos in these buildings because I want to use an FHA loan. So I hope that helps. That was a brilliant question. Hey, Jen, can we squeeze in another? Okay, go ahead.
Brad sent an email. I currently have a VA loan. How does a streamlined debt consolidation loan work with the VA loan? Can I reborrow 100% of my home's value?
Whoa. Hey, my man, you just said a mouthful there. It's like one of those songs where two songs are playing at the same time. What is that called? A mashup. So you just referenced two different VA loan programs, if you will. One is the interest rate reduction refinance loan. You'll hear it referred to as IRRL, IRRRL, interest rate reduction refinance loan. That's typically what people refer to as the streamline refinance because very, very little documentation is required. But here's the thing. It's designed to reduce your interest rate primarily. So pulling a bunch of cash out to pay off debt with an IRRL is usually difficult. Now, the other part of what you mentioned is, could you reborrow 100% and do a debt consolidation loan? The answer to that is maybe. Now, from time to time, there will be overlays on the program that will limit what's considered a debt consolidation or a cash out refinance to 90% or 95% or 100%. And recently we've seen some 100% refinance programs with the VA loan, but it's not the streamlined version. So just know that you're talking about two things. If one is just simply to reduce your interest rate and save some money, then the IRRL is the streamlined version. And this goes for FHA also. FHA has an interest rate reduction streamlined refinance, and they also have a cash out refinance. So two different animals, both very tameable though. It's not a difficult refinance process in either of those loans in either of those scenarios. So, but yeah, I just wanted to clarify because you had a couple different things there happening at the same time. So I hope that helps. Hey, speaking of a couple of things happening at the same time, do you hear that music? Oh my God, Jen is wrangling me out of the studio. You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Man, oh man, time flies when they give me a mic and some listeners, and you guys are bringing some great questions. Hey, if you need us during the week, if we left something unanswered, call or text 855-462-7292, or better yet, just head over to mrmortgageradio.com. That's mrmortgageradio.com. All our contact info's there. All of the resources we talk about each week are there. mrmortgageradio.com. Otherwise, guys, have an amazing week. Jen and I will be back next week. Same time, same station. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing mrmortgageradio.com. That's mrmortgageradio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.